Hey everybody, I'm Tarl Yarber with Fixated Real Estate. I have flipped over 600 homes in my career, and today's market is totally different than what it's been over the last decade. With today's market shifts, how would I build my business differently? What would I do if I was to start from scratch, from nothing, with nothing, and start all over? Could I build my business the same way again? Would I do it differently? I'm gonna give you guys some very key steps on how I would start all over again from scratch if I was brand new, and how I would do it in today's market, and we're gonna go over it right now. If I were to start over again in today's market, what would I do differently? Well, to tell you guys that, I'm going to tell you how I got started briefly. I got started in 2005 when I went to a seminar. Like many of you guys, you might have got started going to a seminar or reading a book or watching something online, but you were by yourself trying to figure this out. Most of us start out on an island by ourselves. So that was me, sitting at a seminar, at a sell-a-thon specifically, where there's a bunch of people there and there's a bunch of big people on the stage, and me not knowing nothing, they're selling seminars on the stage. I was 20 years old in college, bought a seminar for $1,500, right, on wholesaling real estate, and actually was dumb enough and naive enough to do exactly what the thing said. I knew nobody else doing this stuff. I thought I found gold, right? And by a few months later, I got my first check for $5,000. 6 months later, I got a big, huge wholesale check for $100,000, and it changed my life forever. The point of it is that was a rising market. 2005 to 2007-ish, the market kept going up, similar to what's been happening the last couple of years here. Now, I'm not saying that's what's going to be happening over the next couple of years and shifting. It's not the same repeat. It might be a little different. Who knows? But that said, I got out of real estate and back into it in 2011, where I went full-time real estate investor and I started flipping houses. Finding houses were easy in 2011. Finding lenders to pay for them was very, very hard. The market was flatlined, the market was not growing, the market was just basically in a big unknown situation. None of us could have told you at that time that the market would do what it did, because we were still nervous about what the market had just done. Now, a lot of you guys watching this video would be like, man, I wish I got started in real estate earlier. Man, I wish I got started in 2010, 2011. I would have killed it. Well, a good friend of mine says, unless you're the type of person to run into a burning building, you're probably not the type of person that would have invested in 2010, 2011. Now, he says that because nobody knew what was going on. We all thought the market was still crashing. That said, what would I do differently, knowing what I know now, back then? But more importantly, what would I do differently today if I was starting over? And we're going to go over those steps right now. So, first step. Step number one and step number two are interchangeable, and that depends on you and where you are and what you need to get after it. If you're brand new, knowing nothing from nothing, this is the first video that you just watched, you might need to go to step two and then come back to step one. But if you have an idea of where you are, you know what's going on, and I'm in a position, let's say I'm starting over and I'm in a position that I know my strategy and I know what I focus on, then I'm going to focus on number one, which is define my strategy in real estate investing. A big mistake a lot of us make early on in our careers, and what I made early on in my career, is I thought everything real estate investing was open game. I didn't realize that my business didn't get super successful until I only focused on one type of real estate in specific markets, doing specific criteria and specific buying power that I got really good at. And that was flipping houses in specific geographies for a specific margin with a specific type of rehab. So I defined my niche and defined my strategy. So for you guys, the first step I would do if I was starting out today would be to define my strategy. Am I going to flip? Am I going to do acquisitions? Am I going to just buy properties? Am I going to invest in commercial, multifamily, whatever it's going to be, syndications? What's going to be my strategy so I could focus on that and put my eggs in that basket? Now, some of that's going to be dependent on what your skill level is and what your resources are. Where do you stand economically? If you're already set financially, maybe you've had a high-end W-2 job, maybe you've saved a lot of money, maybe you did good on the stock market and then got out of it, maybe you had some real estate and sold it, right? That might be able to put you in a position where you have a little bit more liquidity and you could have better options and maybe define a strategy that allows you to invest money right away. But maybe you're just starting out knowing nothing from nothing, but you got skills that you can build upon to make you good at finding properties, building relationships, partnerships, and so forth, which we're going to get into here in a moment. So that'd be step number one, define your strategy. And that's what I would focus on immediately if I were starting over. All right, so step number two, like I said, is interchangeable with step number one, depending on where you're at in your level in resources, business, and all that great stuff. Step number two is network like crazy, learn and add value. Now, what do I mean by that? If I were you right now, if I was just starting out from day one, the number one reason for my success in my business is because I've networked with the right people. I've networked with a lot of wholesalers, a lot of real estate agents, a lot of escrow, a lot of lenders. I've met all those people. I talk to them all the time. I try to find new ones all the time. I build relationships and I network. And I also love networking with investors that are investing in assets that I want to invest in that I know nothing about. A good buddy of mine, AJ Osborne, he invests in self-storage. If I wanted to go learn about that, I'm going to call up AJ. If Ken McElroy, which not everybody can go reach out to him, but he invests in multifamily. Brandon Turner, mobile home parks. All these people know invest in great deals, but there's so many people smaller than them that are great at what they do, that are out there in your market that you can network with and learn from. Now, how do you get them to talk to you? Well, you got to add value. And that's subject to the person you're talking to. Some of them just don't want to talk to you. So just keep that in mind. Don't get too insulted by that because they don't know you and their time is valuable. Some of them love to give back and help out where they can, but keep in mind their time is valuable. The key, I can tell you this, if you do finally get to network with a higher level investor that you want to get value from and bring value to, and you build a kind of relationship, the thing that most of these guys like the most is that when they give you advice, you actually take it. And then you report back to them on how that went. And guess what they do? They high-five you and give you more advice, and then they hope you take it and you come back. It's amazing what happens with those relationships. So, like I said, depending on where you're at, 1 or 2, you might need to switch. Number 3 that I would change today, right now, is think long-term. Invest long-term assets. Focus on properties and assets that are going to give me recurring revenue and take care of me for the long term. Why am I saying that? I have flipped a lot of houses. Yes, today I have a lot of burrs and rentals and I have doors. I wish I had a lot more, but that's not why I would say to focus on that today. We don't know where the market's going to go. We don't know if the market's going to continue to dip or if it's going to go back up and when that's going to be. But we do know what rents are, and we do know what cash flow equates to, and we do know how to calculate a cap rate, and we do know how to calculate a cash on cash return. So if I buy a property that cash flows 8% a year or 10% a year, right, and my rents are covering my mortgage payment, then I can hold on to that property forever. So the more properties that I'm focused on to build long-term asset and long-term growth, I shouldn't have to worry about what happens in the short term. The properties that I own today that are rentals, that are rented out with long-term tenants for good rent and make cash and cash flow well, I'm not worried about if those market prices drop as far as the appreciation goes, what the value of the property is, if my mortgage is paid. I can handle a dip. The problem would be is if I lose all those tenants and if the rents go down. Market doesn't forecast that at all, especially in the areas that my properties are invested in. Now for you, if I was starting out, and I was starting out myself all over again, and I feel like a noob investor right now in today's market, long-term assets, long-term thinking, think 10 years out, that's what I'd be focused on. Now you might need to take short-term income from flipping, wholesaling, or whatever to invest in long-term assets, but I would be so focused on that to get recurring revenue as much as possible because your future self will thank you. Trust me. 4th thing that I'd be focused on today is never get in a position, which I've been in this position before in my career, is never have to do a deal. Never get in a position where I have to buy something. I have to wholesale, or I have to flip a property, or I have to sell something to live, to pay my bills. Being in a position where you get to choose to invest or choose to do your business is infinitely better than a position you have to. People make emotional mistakes when you get in a position that you have to. Now, if I was starting out again, maybe I have to find a way to pay my bills. Maybe that means I have to take a job. Maybe that means I have to sit there and come up with some sort of active income to take care of my monthly expenses so that I could focus part-time on investing. That might be the best thing to do for your situation. It might have been the best thing for me to do in my past situation. I could tell you I never did that. I jumped headfirst into this thing as hardcore as possible, and I was in the have to for a very long time. But maybe if I did it over again, I wouldn't want to put myself through that stress once more, especially with so many unknowns in the world. Never build your business to a point to where you have to do something. It's the most stressful part, and it's the thing that I hope that you never have to go through. The 5th thing I would do if I was starting out today, and probably, and in my opinion, one of the most important things conservatively to do in today's market, is to spread the risk. Now, what do I mean by spread the risk? When I say spread the risk, I mean maybe partnering with people. I mean coming up with different ways to structure deals to spread the risk out so it's not all on you. Now, spreading the risk might also mean spreading the profit. So let me give you an example here. If I were to do deals today and I'm all by myself and I'm a little hesitant on where the market's going, one way to spread the risk would be to joint venture or partner up with other people on deals and spread not only the downside of the deal, but also spread the upside. Now, sure, you might not make as much money on it, but you're also not taking on as much risk because who knows where the market's going to be. I can also tell you when it's starting out brand new, it's so much more fun and so much easier to do this business when you're partnered with other experienced people. So one of the best parts about partnering with other investors is that other investors bring experience to the deal. They can also bring money to the deal. You can joint venture with them. So maybe you have a partner that brings the capital, right? And you bring the operations and the deal itself. Maybe you have a third person that handles the rehab construction. You find the deal, and the third person is able to bring the money. Now, what I mean by share the risk is if you're all in on the deal, One person might only be paying for it, but all three of you guys are sharing the downside if the market crashes or if you lose money. That spreads it out. So even today, right now, in my own business right now, I'm looking to partner with other people, and I'm also looking to spread the risk. Number one, it makes me feel a little bit more comfortable. And number two, it is a lot more fun, in my opinion, when you partner with the right people and you have a good time sharing the profit, sharing the experience, sharing the deals. That said, another way to be able to spread the risk is to look for non-recourse loans or get to a position in your business as quickly as possible so that some of the borrowing, some of the financing that you can get become non-recourse. Basically what non-recourse is that you're getting a loan on a property that you're not having to sign a personal guarantee for. Now, this is typically what happens for big commercial deals, multifamily, and sometimes if you have a portfolio of single family, there's some lenders out there that will give you a non-recourse loan on single family. They're not very common and they're not always the best terms, but getting to a position where you can get rid of the recourse side of your, so you can get rid of the recourse, hold on, I got a bug. So you can get rid of the recourse side of the borrowing, the less risk you're gonna have. In addition, if you have already a team and you maybe have, or you wanna build a team up, if I was starting over again, I would be focusing on profit share with people to bring onto my team and not salaries. That's another way to reduce risk and spread the risk as well. If all of a sudden you hire a bunch of people for salaries every single month of your business, you're taking on more risk with overhead. Perhaps maybe early on, structure in a way that you can do profit share so that they're getting paid in the deal if you're doing a deal, or getting paid in the equity if you're doing larger deals. Lots of ways to spread the risk, lots of ways to reduce it, and also have more fun and less stress in today's market. The sixth and probably my favorite one, which is niche out once I figure it out. So in my business, when I was brand new, I didn't know what I was doing. I was just doing, right? And as I got better at the business, I started niching more in the business. The people I've seen the most successful today in this business are the ones that are really good at specific assets and specific types of geographies and specific types of buying boxes. So the more you can niche out, the better. So what do I mean by niching? What I mean by like specializing in certain type of assets and specialize in certain types of geography and whatnot. Now you could be in multiple locations and still niche out. Each location might have a different niche investment that you're interested in. So how do you niche out correctly, right? That's going to depend on the location you're in. What should you be niching out on? Totally depend on the location you're in because it's based on demand. It's based on path of progress. What's path of progress? That's showing where the actual growth of a city is going. If you can buy something niched out in an area before the progress gets there, that's even better. Maybe you like to focus on little mixed-use multifamily properties. Maybe you like to focus on three-bedroom, two-door ramblers in specific types of cities in the suburbs, right? Whatever it is, the more focused you can get on that, the more specialized you're going to be at it, the more profits you're going to make. Remember this, more doesn't always equal more money. More properties doesn't always equal more profits. More properties could equal more headaches. More properties could equal more risk. But when you niche out, you can get larger margins and protect your downside a hell of a lot more, especially in today's market. So focus on that. And last but not least, this is just kind of something to throw out there. No matter where you live, remember this, you're not a tree, you don't have roots, you don't have to invest where you live. You can focus on multiple different areas and go where the opportunities are. Starting out today, if I was starting over, I wouldn't just be looking at where I live, I would also be looking at the other markets that are doing better because maybe the market that I'm living in isn't doing that hot. And maybe other markets are doing far better or have better opportunities. You can invest from afar. There's a lot of videos that are out there that tell people how to do this. There's a tremendous amount of savvy investors that do it every day, whether they're brand new or not, doesn't matter. You can do it too. You just got to get a little bit creative with it. So, like I said, starting out, those are some 7 keys tips that if I were to start over today, that's what I'd be focused on right now. That's what I actually, believe it or not, spoiler alert, that's what I'm doing right now in my business. Starting over. Not technically, but reevaluating my business to go, should I take these 7 steps into account for my own business? And the answer is yes. That's what I'm focused on right now. And if you guys are like me, I hope you're focused on it as well. And make sure you guys comment, like, subscribe to this video, like Bigger Pockets, check out biggerpockets.com. Make sure you go to my Instagram page at Tarl Yarber. Follow me there. You can comment on this video. I do my best to reply to it, and I'll see you at the next video. This place is completely different, completely transformed than it was prior to us finishing it up now. You always want to put your money into the kitchens and the bathrooms as much as possible, update the finishes as much as possible too, to get the highest value. But we don't really change our finishes too much in particular neighborhoods that we work in because if the finishes work, why do we need to change them?